video on YouTube. In today's episode, I will explain why I got stopped out on this trade, and I'll also give reasons or explain what I should have done better to not get stopped out. Before we start, I'd appreciate if you like and subscribe, it helps a lot. First, you can see that we mitigated this 1 hour order block right here. And if we drop down to a lower time frame, you can see a little bit better that we have the AMD model right here, which means there's an accumulation or consolidation, however you want to call it, then a manipulation. Most of the time this takes place during London session, so you have the accumulation during Asia session, the manipulation during London session, and then the distribution during New York session. Right here there also was a great entry opportunity targeting the accumulation low. However, I missed this one because I wasn't at the charts at that moment. So we have accumulation, manipulation, and then we have a distribution to the downside, which is right here. So it's an accumulation, then we usually take out both sides of the range. First, the liquidity that built up above the size, and then the liquidity that built up below the size. This is the manipulation. And then we return into some kind of PD array in the premium or discount zone and distribute to the downside. Typically, this impulse is what I trade. I wait for the accumulation, then the manipulation, and then the distribution to the downside. Sometimes I also trade the manipulation, so I wait for manipulation to happen, and then I trade the manipulation targeting the consolidation lows. And after the AMD, we usually also get a continuation, so we break structure to the downside and then return again to a PD array and continue lower. This is also what I traded today. I traded this continuation part, which is right here. So we broke structure to the downside and then returned into PD arrays right here. I take my Fibonacci retracement tool, and you can see that the optimal trade entry range is around here. Right here you can see that there's an order block. Then we have some equal highs right here, which act as an inducement. And then we have this order block at the extreme point of the price leg, which would be my optimal entry point, because right here most people would enter targeting these lows, and they would all put their stop losses above this zone. So this line represents all the stop losses from the retail traders, and price looks to sweep these stop losses to then continue lower with higher momentum, which you can see right here. We break structure to the downside after mitigating this order block. Now I drop down another time frame to the 15-minute. Oh no, to the 5-minute. You can see it a little bit better. Right. So now we sweep into this point of interest, into this zone right here. We close back into the zone on the 15-minute, and then we shift structure to the downside with a lot of momentum. And this is one of my confirmations that this trade will play out the way I'm looking for. We also get this break of structure. And yeah, then I take my Fibonacci retracement tool again and draw it from the high to the low. And I look for PD arrays in the premium zone, which we have right here. And right here. And we also have this fair value gap right here. So these are all PD arrays which are in the premium zone, but I would not trade from these two because, as you've seen before, these are inducements. Sellers will typically step into the market selling from here, but as you can see, there are PD arrays above, so it's not optimal for me to enter from these zones. So I wait for price to sweep into these zones and then enter from this extreme POI. Yeah, I enter from here. I put my stop loss slightly above the size and then target sell side liquidity, which would give me a pretty good risk reward. As you can see here, a 9.76 risk reward. But as you can see, I got stopped out pretty quickly. And I basically missed out on all this profit. I think it would have been $1,000 or something like that. But yeah. Now, why did I get stopped out? Because my stop loss was a bit too tight. And also I could have waited for a candle confirmation on the lower time frame. The first method, which I should have used to not get stopped out, is using the ATR indicator. To add the indicator, you first have to go to TradingView. If you don't have it, you can click the link in the description and you'll get a discount on your premium plan. And of course, you'll also support me because these videos take a lot of time to create and a lot of work. So yeah, I'd appreciate if you use the link to sign up. Then you have to go to the indicators tab and type in ATR, which means average true range, because it calculates the average candle size over a certain period of time. then you have to click on it and it will appear at the bottom of your screen. Now, if you click on it, you can see that you can adjust the length. In this case, it calculates the candle size of the last 14 candles. You can adjust it, but I wouldn't recommend because this is the default setting, and yeah, I would only use that. Now, what can you use the ATR for? If you open this indicators tab and move your cursor to this candle, which is the candle I entered from, you can see that it spits out this red number at the bottom. In this case, it was 52 pips, meaning the last 14 candles had an average size of 52 pips. And then I'll go to the short position and I'll add the 52 pips to my stop loss, which would be 106 pips. Now you can see that the risk-reward ratio isn't as big as before, but the trade didn't hit the stop loss, and this is all that matters. So yeah, this is the first method how I could have avoided this loss. Another way I could have avoided this loss is by dropping down to a lower time frame, in this case the 1 minute time frame, and wait for a candle confirmation. In this case, you can see that we had this very bullish candle right here, which eventually stopped me out at this point. And then you can see that we have this bullish candle right here, and then one candle which closes below these two bullish candles. This pattern is called an engulfing candle. So this red one is a engulfing candle, and I should have entered from this one. So I wait for the close of the candle and then enter my position with my stop loss again still above these highs. And then target sell side liquidity around here. As you can see, this gives us a much better risk reward and yeah, prevents us from unnecessary losses, because we went to the lower time frame and we entered once we saw that price has turned bearish. And yeah, this is how we would have avoided this loss. If you found the video helpful and learned something, I would appreciate if you like and subscribe. And to also give you something back, I decided to give away two 25k challenge accounts from Goat Funded Trader. All you have to do to take part is subscribe to this channel and Goat Funded Trader. Second, like and share this video with a friend and write a comment. I'll then announce the winners in my Instagram story and also in my free Telegram group, which you can find in the description. Thank you for watching and see you next week.